Howdy, Jacob here. Today we're looking at Kinetik Holdings, $1.9 billion market cap with a $5.5 billion enterprise value. Good amount of net debt, over double the enterprise value as net debt. 8.8% dividend yield, so looks massive from that. Let's look at this debt. So 2.2 billion in 2019, 3.4 billion now. It's like they've just been issuing debt. Their dividend of 73 million, payout of 73 million. 73 million, okay, so increase of debt there. I feel like their payout is fine given the last 2 years, but before that, if we look at 2018, 2019, and 2020, they had negative free cash flow. So you got to wonder whether they're going to stick with, 150 million, roughly 390 million in free cash flow, or whether they're going to go back to where their cash from operations can't withstand their capital expenditures, what it takes to just keep the business afloat and everything. So it looks like they've been making a lot of acquisitions, a good amount of acquisitions, and also been using a little bit of their cash flow on dividends, issuing debt to fund those acquisitions if they haven't had the cash from operations for it. So I can get right to it. I don't want to go too crazy on here. So not a lot of data to run off of, but I think it's an oil, gas, and consumables business. I'm going to say 0 growth, 10 on the P, price free cash flow. Margins, I'm playing with fire here, 10, 20, 0%. Again, their payout looks fine, but to me, I'd say if they were to cut that in half, maybe with the seasonality of the business, they could afford that. But to me, this is going to be a business that, similar to some of the other oil and gas industries that we've seen, where when they make a lot of money, they send out a lot of cash flow, and when they don't, they either have like a really low payout or don't have a dividend at all. So their dividends can be very relied upon the seasonality of the business. And as of right now, I would presume it might be at the peak or close to it. And so I think that as business goes back down, revenues don't exceed expenses, they're probably going to cut the dividend down. So maybe for a conservative, we'll say they cut it by 2/3. And that would give us, with all the assumptions set, the company's price would have to fall 41% to give us a 15% return with this assumption. I think right now, there's just not a lot of data. So even when I do a deep dive on this company, if it drops another 30, 35%, it's going to be tough to analyze. And companies that just don't have a lot of data, you're really going to be relying on the story rather than the numbers of the history. And so keep that in mind if you hopefully doing this analysis yourself. Keep that in mind that the less data you have, the less reliable you are, the greater margin of safety you're going to need. So just keep that in mind, and hopefully everyone has a good rest of their day. Thank you.